Hi trader, this is Chris from Admiral Markets with a video on market patterns when using technical analysis. Before we do that though, be aware that trading for exchange and global financial markets is considered high risk, may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar, this recording is not advice and is for informational and educational purposes only. And by continuing watching this video, you agree with this disclaimer and you're aware of the risk involved when trading. Now, there are many types of patterns, in fact, in the market, and Nenad and I like to discuss patterns, so join our webinars to find out all of these, but we're going to mention a couple of the ones that we find the most interesting. First of all, impulsive and corrective patterns. As you can see here on the right where it says impulsive, obviously those are parts where we have bigger candles to one side or other, bearish or bullish, and there's a lot of momentum in that candle. There's a sizable candle, the close is near the high or low often enough, and these candles kind of dominate the chart pattern or the chart. So these are impulsive candles. Corrective are smaller candles, often going sideways, and there's no clear winner in a range of candles. So from that point of view, of course, that's a very clear pattern. The market does either the impulse or correction all the time, and it's like the heartbeat of the market. So very clear kind of distinction that always happens in the market. This is the rhythm of the market. Now, when we dive into, of course, analyzing impulse and correction, we can label those impulses and correction with waves, and that's what wave analysis is all about. And that's what I do at Admiral Markets, and I have wave analysis that is shown daily. And I talk about 1, 2, 3, 4, 5 patterns and ABC patterns, as you can see in the graph on the right. Often enough, these wave patterns are consolidation patterns. A wave 4 is basically a sideways move, and a wave B could be a sideways move, for instance, where we have, for instance, flags, as you can see here in orange. It's a correction, and it's a type of bear flag chart pattern. That's a typical consolidation pattern that you see when price is correcting. Now, we also have, of course, price action patterns, as indicated in yellow. At the very top, it's difficult to see, but that's a shooting star. It's an indication that the momentum that was rising until that point is maybe running out of steam. A candlestick like that, a shooting star, indicates that, well, this momentum might be over because we see a shooting star at the end of an impulse like that. So that's a price action kind of candlestick pattern that is indicating that, well, this momentum could be reversing. And that's, of course, only more kind of patterns that we have. We don't have only those, but we have time of day patterns, bounce and break patterns, trend patterns, reversal patterns, divergence patterns. Let's dive into a few of those. Obviously, when you have a reversal patterns like a falling wedge, which is a chart pattern, or a divergence pattern, which is also a reversal pattern indicated by purple, and a rising wedge, which is the opposite of the falling wedge, those are signs that we're going to have, or the price might reverse against the prevailing trend, and we could see the opposite happening. And this is what happened on the euro dollar recently, of course. We also have trend patterns where we have higher highs and higher lows, or lower lows and lower highs. Those are patterns and sequences that basically are visible in the market. We have bounce and break spots when price breaks through a trend line, breaks through support or resistance, or price uses that as a bouncing spot. When price here on the right bounce off the 50 fib, that's also obviously very often we see that in the market where price reaches a decision spot, a fib, trend line, moving average, and price is going to either respect it and bounce or break through it and choose maybe a new direction. So those are very important. Time of day patterns, of course, time of week and month patterns as well. For instance, trading the pound dollar in the Asian session, often very rangy and choppy, whereas trading the Aussie is better on average, or trading the pound USD throughout the London session obviously is on average has a higher volatility than the Asian session. Those are time of day patterns, for instance. Now, these are just a couple of patterns, but just to give you an idea about technical analysis. So if you want to add any of the patterns that you think are missing, we gladly hear from you. Write down below in the YouTube chat or in the blog chat if you're looking on the website, and we'd love to see your comments. And if you're interested in more patterns, Nenad and I discuss that very frequently because we have webinars on Monday, Tuesday, Wednesday, and Thursday where we discuss a wide range of topics, in fact, from opinions to educational content to setups to live webinars. Hope to see you in these live events, and wish you all good trading. Cheers.